You know, we're all taught the same thing. Save your money, put it in the bank, watch it grow, you'll be safe, you'll be secure. But what if I told you that the wealthiest people in the world, they do the exact opposite? That keeping all your cash in a savings account might actually be one of the biggest financial mistakes you can make.
I mean, of course it does. It feels good, right? To see that number go up. It's our safety net, a sign that we're being responsible. It's tangible proof of all our hard work. That balance in your account, it feels like security.
But what is that safety actually earning you? Well, the national average interest rate for a savings account in the US is kind of floating around 0.5%. Let's be real. That's not growth. That's basically life support. It barely has a pulse.
So what if that feeling of security is just an illusion? What if the money you think is so safe is actually leaking value, day in, day out, just silently disappearing? Today, we're going to pull back the curtain and expose why millionaires treat huge piles of cash like a ticking time bomb and what they do instead.
All right, so here's the game plan. We're going to break down their entire playbook. First, we'll uncover this thing called the cash trap that so many of us fall into. Then we'll introduce you to your money's absolute worst enemy, a silent thief you might not even know is there. From there, we'll dive deep into the millionaire mindset, see exactly where they put their cash instead, and then we'll wrap it up with how you can start putting your money to work, starting today.
Okay, Section 1, the cash trap. Let's talk about why that conventional wisdom, playing it safe with your money, is maybe anything but safe. Ever since we got our first piggy bank, right? The message has been drilled into our heads, save your money. It's the responsible thing to do, the sensible path. But here's the reality, the one the wealthy operate under. Cash isn't some treasure to be hoarded. It's a tool. And it's a tool that, when you let it just sit there, it rusts, it depreciates.
This brings us to a really core idea in economics called opportunity cost. A simple way to think about it is this. Every single dollar you have is like a tiny employee. Now, if that employee is just sitting in a savings account earning 0.5%, well, they're basically asleep on the job. The opportunity cost is all the money they could have been making for you if you'd put them to work in stocks or real estate or something else. It's the potential you give up for that feeling of safety.
So let's see how this builds into an even bigger problem. Section 2, your money's worst enemy. See, there are these invisible forces out there that are actively eating away at your cash savings. And the biggest thief of them all is inflation. Look, central banks actually want inflation to be happening at a slow and steady pace to keep the economy humming along. But that directly impacts your savings. It just means the price of everything, gas, groceries, it all goes up over time. So your dollar buys less tomorrow than it does today. If you have, say, $10,000 in the bank and inflation is chugging along at 3%, by the end of the year, that 10 grand can only buy what $9,700 could buy before. You didn't spend a dime, but poof, you lost $300 of real value. And this is exactly why the idea of cash being a safe harbor is so dangerous. A much better way to think about it, your cash is a melting ice cube. The only question isn't if it's going to melt, the only question is how fast.
So, if holding cash is actually so risky, what's the psychology driving millionaires to invest at all? Well, that brings us to Section 3, the millionaire mindset. And you might think it's all about greed, but the truth is, it's driven by something way more powerful: fear. This all comes from a Nobel Prize-winning idea in behavioral finance called loss aversion. It was pioneered by guys named Daniel Kahneman and Amos Tversky, and it's a huge deal in how we understand money today. All it really says is that for us humans, the sting of a loss feels about twice as bad as the pleasure we get from an equal gain. And this just nails it, right? Gaining $1,000 feels pretty good, but losing that same $1,000, oh, it's devastating. It's like a punch to the gut. We are literally hardwired to avoid losses at all costs. So here's the secret. This is the crucial point. Wealthy people feel that slow, silent loss from inflation not as some boring economic idea, but as a real, painful loss. Because of loss aversion, that fear of their ice cube melting, of their buying power going down, it is a huge motivator. It forces them to act. And this fear-driven mindset, it leads to a totally different strategy for managing their money. Which brings us to Section 4. So where does the money actually go? Okay, the main strategy here isn't trying to find the next hot stock that's going to make them rich overnight. It's about building a solid, diversified portfolio. You see, they're not trying to pick the winning horse in a race. They're trying to own the entire racetrack. So what does that racetrack actually look like? Well,
It's a carefully built mix of all kinds of different things. You got your usual suspects, right? Stocks and bonds. But then they start layering things on. They add in real assets like buildings or infrastructure projects. They add commodities like gold to protect them if things get crazy. They get into private markets, investing in companies before they're on the stock market. And more, you see these big thematic bets on huge trends like AI or climate tech.
And the reason for all this complexity, it isn't just about chasing the biggest numbers possible. It's about survival. It's about building a financial fortress that can handle anything the world throws at it. Recessions, market shocks, you name it.
And this is where the pros really think differently about risk. This one study showed it perfectly. A standard portfolio tries to reduce all the ups and downs, but a downside-focused portfolio, well, it only really cares about minimizing the bad kind of volatility, the crashes. And just look at the results during a huge downturn. The standard portfolio got absolutely hammered, down almost 40%. The one focused on defense, it was down less than 24%. That 16% difference, that's the power of focusing on not losing money first.
Now, I know this can all sound super intimidating, but the core ideas here are actually accessible to everybody. So let's get into our final section, putting your money to work and your first real actionable steps.
First things first, we are not talking about investing your emergency fund. Step one always is to build that safety net. Get 3 to 6 months of your living expenses saved up. But don't just let it rot in a normal account. Put it in a high-yield savings account so it can at least put up a fight. That is the only cash that gets to be a lazy guest. For the rest of it, step 2 is just to open the door. Get a low-cost brokerage account. And step 3 is to start diversified. You don't have to be a stock-picking genius. A simple low-cost index fund is the easiest way to instantly own a piece of that whole racetrack we talked about.
And why is it so important to just get started? Because of what Albert Einstein supposedly called the most powerful force in the universe, compound interest. It's your money making money, and then that money starting to make its own money. It creates this snowball of wealth that just grows bigger and bigger and bigger over time. And the most important ingredient isn't how much you start with, it's how much time you give it. So we end up right back where we started. You can treat your money like a guest in your house, one that just sits on the couch, doesn't help out, and gets a little weaker every day. Or you can treat it like an employee, one that works for you around the clock, 24/7, to build your future. The choice really is yours. So which one are you going to choose?